Script 6 to 8 minutes executive summary. The recent Federal Reserve decisions regarding interest rates and mortgage rates will significantly impact various aspects of American households. While mortgage rates do not move one for one with the policy rate, they can be affected indirectly through broader market conditions.
That's the key context. What happened? Recent policy changes made by the Federal Reserve were announced recently. This decision could affect borrowing costs for consumers across different sectors, such as credit cards and savings accounts. Additionally, it may influence home financing options, potentially increasing the cost of mortgages for buyers.
Why it matters understanding how these policies work is crucial in managing personal finances effectively. For instance, high interest rates can increase monthly payments for creditors while reducing returns on savings for savers. Homebuyers might face increased costs due to higher mortgage rates. Affected groups' creditors. Higher interest rates mean more expensive loans.
Right, and this is where the practical warning signs matter. Home buyers, increased mortgage costs deter purchases. Savers, lower yields on savings accounts due to higher short-term rates. Verified claims mortgage rates are influenced but not directly linked with the policy rate. Rather, they can change based on overall economic conditions affecting housing demand.
Unverified or unknown specific dollar examples or detailed models behind these claims need further research. Primary sources needed official statements from the Federal Reserve and industry analyses focusing on real estate finance and consumer debt management would provide valuable insights into the impact of these decisions.
Secondary sources needed academic studies on monetary policy's effects on financial markets and market analysis reports, detailing the broader implications of changes in interest rates on various sectors would be beneficial. Executive summary. The recent decisions by the Federal Reserve have significant implications for various aspects of U.S. household money management.
Key points include potential shifts in credit card fees, lower returns on savings accounts, and increased mortgage costs affecting homeownership opportunities. This news underscores the importance of understanding how central bank actions affect everyday borrowing and saving behaviors.
What happened? Recent policy adjustments made by the Federal Reserve could influence lending practices and home financing options significantly. These changes may lead to higher interest rates for borrowers and potentially more expensive mortgages for buyers. Why it matters understanding these policies is crucial for managing personal finances effectively.
Consumers must adapt their spending habits based on new loan terms and adjust savings strategies accordingly. Affected groups' creditors. Higher interest rates increase monthly payments. Homebuyers. Increased cost of mortgages might deter purchases. Savers. Lower yields from savings accounts due to higher short-term rates.
Verified claims mortgage rates are not directly linked with the policy rate, but can be influenced indirectly through market dynamics. Unverified or unknown specific dollar examples or detailed economic models behind these claims need further research.
Primary sources needed official statements from the Federal Reserve and industry analyses, focusing on real estate finance and consumer debt management. Secondary sources needed academic studies on monetary policies, impact on financial markets and industry analyses, focused on real estate finance and consumer debt management.
Executive summary. The recent decisions by the Federal Reserve regarding interest rates and mortgage rates will significantly impact how U.S. households manage their money. What happened? Recent policy adjustments made by the Fed could affect various aspects of borrowing, including credit cards and savings returns, as well as housing costs for homeowners.
However, mortgage rates do not move one for one with the policy rate. Instead, they may fluctuate based on broader market conditions. Why it matters understanding these changes is crucial for managing personal finances effectively. For instance, high-interest loans become more expensive, while savings opportunities diminish in terms of yield.
This information helps consumers make informed decisions about spending, saving, and investing. Affected groups' creditors. Higher interest rates increase monthly payments. Home buyers. Increased cost of mortgages might deter purchases. Savers. Lower yields from savings accounts due to higher short-term rates.
Verified claims mortgage rates are influenced indirectly through market dynamics, rather than directly correlating with the policy rate. Unverified or unknown specific dollar examples or detailed economic models behind these claims need further research.
Primary sources needed official statements from the Federal Reserve and industry analyses, focusing on real estate finance and consumer debt management. Secondary sources needed academic studies on monetary policies, impact on financial markets and industry reports, analyzing the effects of changing interest rates on lending practices and home financing options.
Executive summary: the recent decisions by the Federal Reserve regarding interest rates and mortgage rates will significantly impact various aspects of household money management. Consumers should monitor their credit card fees, savings returns, and housing costs, as these factors could change based on new borrowing conditions.
What happened? Recent policy changes made by the Federal Reserve were recently announced. This decision is expected to affect how lenders operate and what homeowners pay for loans. The exact impacts vary depending on individual circumstances, but generally include increased borrowing costs and potentially higher mortgage rates.
Why it matters: understanding these policies helps individuals manage their finances more effectively. By keeping track of changes in lending practices and home financing options, consumers can make informed decisions about borrowing and saving. Affected groups: higher interest rates may increase monthly payments. Increased cost of mortgages might deter purchases.
Lower yields from savings accounts due to higher short-term rates. Verified claims mortgage rates are not directly linked with the policy rate. They can be influenced indirectly through market dynamics. Unverified or unknown specific dollar examples or detailed economic models behind these claims need further research.
Primary sources needed official statements from the Federal Reserve and industry analyses, focusing on real estate finance and consumer debt management. Secondary sources needed academic studies on monetary policies, impact on financial markets and industry analyses, focused on real estate finance and consumer debt management.
Summary: the latest Federal Reserve decisions will likely affect credit card fees, savings returns, and mortgage rates. Although mortgage rates do not move one-for-one with the policy rate, they could still be impacted by broader borrowing costs. What happened? Recent policy changes by the Fed were made public.
This decision could influence how lenders operate and what homeowners pay for their homes. Why it matters: understanding these changes is crucial for managing your own money wisely. Affected groups: creditors. High-interest loans may become more expensive. Homebuyers: higher mortgage rates could discourage home purchases.
So let's bring this back to what borrowers can do. Savers. Savings account interest might decrease because of increased short-term rates. Verified claims mortgage rates aren't directly tied to the policy rate. However, other factors like market conditions can drive them up. Uncertain information, specific dollar figures, or detailed economic data about these impacts require additional study.
Exactly. Primary sources needed official Fed announcements and industry analyses related to monetary policy's effects on financial markets. Secondary sources needed academic research into the relationship between monetary policies and financial outcomes in general, as well as specific studies on housing finance and personal debt management.